Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Welcome to the latest episode 47 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, today's a really special one. We've got an awesome guest. We've got Neil Dutta from Renaissance Macro. We're titling this one, Talking Macro with Neil Dutta. Neil, we'll go to you in 1 second. Sonu, I know you've been excited for this one for a while, haven't you?
It's been, So Neil, just so that everyone has some background, Neil is, one of those economists or business economists. I mean, I would probably draw a distinction there between like your academic economist or Wall Street, even Wall Street economist. Neil is, I think, much more a practical economist, and you'll see why. I mean, he's someone, Ryan and I, we love to read his stuff. We love to follow everything he says and, puts out on Twitter and all of that. So thank you, Neil, for being here. This is an honor.
My pleasure. Thanks for having me.
Yeah, this will be fun, Neil. So it's like I said, we've got about 30 minutes or so. But, some people might not know you out there, but, they should, because you've made some really good calls this year. Just tell us briefly about your career, kind of what you do with Renaissance Macro and what you do all day besides doing a fun podcast with us.
Sure. So Renaissance Macro Research is a broker-dealer, sell-side broker-dealer that specializes in macro, providing macro research sort of solutions to the buy side, people like you. What we do is cover sort of three core macro verticals, which is economics, which is what I run, and policy. So we have someone in Washington, D.C. kind of telling us about what legislation is moving through committees in D.C. and how, investors can leverage that information. And then we have someone, Jeff DeGraff, who has been ranked in Institutional Investor as one of the top technical analysts. He basically covers the market technicals and strategy, plank of it. And it was founded in 2011. I joined in 2012. I before that, I was a senior economist at Merrill Lynch. Well, I mean, Bank of America Merrill Lynch is what it was called after I left, when I left. But I got my start under, I mean, it's kind of funny to think about it, but under David Rosenberg. Okay, so a notorious economic and market bear,
right?
Very well regarded. And then I after he left to go back to Canada, I worked under Ethan Harris, who recently retired from Bank of America. So that's sort of how I got my start. So it was an interesting kind of upbringing, if you will, because I think, Rosie was sort of a market machine, like a classic market economist, always, aggressively marketing his views and, not always willing to kind of challenge the consensus. And Ethan, I think, was also, he was a great economist. I mean, when I think about great Wall Street economists with, very strong academic pedigree, Ethan Harris is the one that comes to my mind right away. So it was sort of a good background for me to kind of come into my own, because you kind of got both sides of the, of how to approach the job.
Let me jump into something here, Neil. We're going to get it all into the macro views real soon. But so obviously you worked for big companies, right? Big companies with lots of layers and lots of people. And now you're at a smaller company, I think it's safe to say, kind of running the ship by yourself. We have a lot of financial advisors, a lot of independent financial advisors that are running their own companies that are listening to this as well. What's kind of one of the main things you've learned when you're on a smaller team running your own company versus when you're in the layer of the machine?
Well, it's a much more flat structure, and I have a lot of latitude in terms of what I can do and say. I mean, so for example, I mean, if I was still at a large institution, I mean, getting on this podcast would probably be
Exactly.
I don't know, like a
Yes.
3-month process. I mean, who knows? I mean,
Yep.
it's you know, so
Yep.
so I think that aspect of it is better. But I think you also have a lot of like intellectual independence at a smaller shop, because remember, when you're at a larger institution, and I don't know that it's necessarily bad, but there's a house view, right? Like, so you have to make sure that what your strategist is saying kind of aligns with what your economist is
Right.
saying, kind of aligns with what your bond person's saying, and obviously that's a very difficult thing. And because of that, it takes more time to sort of get ideas out. And um, I think at a smaller institution, I mean, we have no rigid structure where I have to agree with what Jeff is saying. That's our markets guy, or you know, or he has to agree with what I'm saying. And for me, I think that's sort of the way I've conducted myself. I mean, I'm not, my client, people that follow me, don't come to me because I'm the one that's running the best regression or like I have the best econometric analysis. I mean, that's not why they come to me. I mean, to me, it's much more important in the seat that I'm in to sort of get there first with a solid B, as opposed to getting there last with an A plus. You know what I mean?
Let me jump in. So Sonu, go to you 1 second. Let me just jump in, because what you just said is music to my ears. I've been with the Carson Group for a year now. We've got a much smaller team than what I was used to in a past life. We can be more nimble, quicker. So here's my question, Neil. Sonu and I were in the camp, along with, I know you guys, late last year, early this year, saying, listen, there's probably not going to be a recession. And Jeff has been all over the potentially higher equity prices as well. So in a nutshell, what made you guys go so against the grain? Because again, we were in that camp and we were slammed by so many vocal bears, and we were talking about before we hit record some of those friendly vocal bears that were mean to us. But look where we are now. What were you guys watching, you think, in 90 seconds that really made you go against the grain, that said this year might be a lot better than everybody else is expecting?
Well, I think you start with why there was so much caution to begin with. We basically had a massive food and energy shock because of the invasion of Ukraine, and we had an aggressive Fed. That's where it started. So then you fast forward. So I don't think it was wrong to be worried about recession last summer. But then we kind of dealt with it, and then food and energy prices came down, particularly energy prices. That lifted disposable incomes. And the Fed was getting a little bit more, sort of wishy-washy on what they were doing. They were sort of cooling it with the 50 basis point hikes. They started going every other meeting, right? So the recession risk was fading rapidly, in my view, by the end of last year. And I think to start the year, the fact that the housing market picked up a little. Remember, in the beginning of the year, we had that period where everyone was sort of betting on a Fed pivot. You had rates come down pretty sharply, and the housing market just took off very quickly. That to me was a tell. I mean, if you're able to generate that much activity in housing with rates going from 7 to 6.5, that tells you about underlying demand. And so, that's why I say, I mean, the Fed broke housing once. It's hard to break it twice, and the housing market was picking up. And, so to me, it's sort of, remember, the people that were talking last year, guys, about housing is a leading indicator. It's right. You don't talk to me about Ed Leamer. I mean, it's like as if you've discovered something like, earth shattering. So now it's gone back up. What are they saying now? New home sales are up about 20% against the last year. And obviously we know what builder stocks have done this year. So, the fact that housing is working, and that's now spreading to other areas of the economy. So I do think recession risks have come down.
And right now you're in the camp of that the economy is actually accelerating, right? I mean, I know Fed economists have finally come around to saying, oh, we don't think there'll be a recession this year. So I think Fitch and Moody's still say, okay, there'll be a recession later this year, early next year. But you're not in that camp, clearly.
Well, I think that you have to be a little bit. To me, the recession call is really about whether you think that's necessary in order to quell inflation. That to me is what it comes down to. I don't think we're going to be in a recession at any point in the next, 6 to 12 months. But that may be one reason why I'm a little bit more cautious about 2024, because because it would just suggest that the Fed hasn't done enough. To me, I got crucified, I feel like, earlier in the year because I was saying no landing. And everyone was saying, oh, how could you say that there's not going to be a landing? Everything has to land. I mean, to me, it's really just this business is about what's priced in and what you think is going to happen, right? And the market and the consensus was saying that there was a recession imminent, like an imminent hard landing, a weakness in the economy, some combination of that. So I didn't really care what you called it. No landing to me just meant the economy is still growing and there's not going to be a recession, at least when the consensus is saying it. So, and right now, I think there is some risk the economy accelerates because it goes back to the original point, right? I mean, you're going to get a lot of disinflation in the pipeline because of what's going on with cars and shelter, and labor markets are still strong, and that's going to juice real incomes, and people will go out and spend the money.
Neil, talk to me about inventories to GDP. This is something that we've talked on this podcast before about, talk high level so it's easy to understand. But I know you've talked before, inventory could be a tailwind to more GDP, right? Why is that?
Oh, absolutely. Yes, of course it could be a tailwind. Because, right? And so, think about last year, right? We had this massive rotation of goods consumption, right? Because of the pandemic dynamic. And so you had a overhang of inventory last year, which was another downside risk to the economy. As people shifted to services, we had a lot of excess inventory of goods. That's since been worked off, and now we're at a point where inventories have basically been, cutting GDP growth by a substantial amount for the last, 4 to 6 quarters, let's say. And we're kind of on the other side of that now. And goods spending is accelerating, which means that inventories are going to have to follow. And, look, inventories is one of these things that, over a long stretch of time, it doesn't really matter for GDP. But in the short run, it can contribute an outsized amount to the cyclical swings in activity. And, I think inventory restocking is a tailwind for growth, over the next couple of quarters. You're already starting to see some evidence for that. I mean, as an example, rail car loadings are starting to pick up. You have more, purchasing managers telling you their inventory levels are too low. But one thing I think is important for people to remember is that you'll always have people on the bearish side of the fence making the argument that, look, inventories went up. That's a one-off. It's not a big deal. Look through it. As you know, Ryan, it's the same as, this rally is just one big short squeeze.
Exactly.
Well, that's how it always starts.
They always start as a short squeeze. Exactly.
Right. And cycles start with an inventory restock. What happens when inventories get restocked? You have to hire manufacturing workers, or at a minimum, you have to extend their work week, right? And that means that they get more money. Then they go out and spend. And then you have a positive feedback loop. So, I think the inventory cycle is going to be an important driver of activity.
Let me just jump in, Sonu, one second here. You can go next. I want to dive in a little bit more on this because here's what's fascinating to me about the inventory story. I'm not hearing anybody talk about it. I've seen you on CNBC. I've seen you on different places talk about this. Sonu's been talking about it. A few of us have. Why is it, though? And this might be, like who's buried in Grant's tomb. Why are people ignoring this obvious data on the inventory that says, hey, the economy could be better? Do you have any clue why they're ignoring it?
Well, I think part of the issue might be that, manufacturing is what we manufacture is largely exported. So it's these are tradable goods. And so because global growth is a little bit more sluggish, we see the headlines in China. Everyone's talking about weak growth in China. China's been sort of the linchpin for global manufacturing for so many years. I don't know that that's the case anymore, frankly, but it had been the incremental sort of source of global demand, during the years following the financial crisis. And so I think that's probably one of the reasons why people have been ignoring it.
Okay.
Interesting. Let's take the manufacturing topic. We've seen some of those shots of manufacturing construction now. Speaking of, businesses investing, things like that, private investment was actually pretty strong last quarter, especially. And one thing you mentioned at the top is your shop, Renaissance, also does, looks at what's happening in DC, right? I think Steve Pavlik does such a great job with that. And this quote, I'm going to say it anyway, but, despite this being, neutral. But so Mike Wilson from Morgan Stanley, a favorite of Ryan's, he's recently said, okay, I'm changing my call. And he said, he sort of blamed persistent fiscal spending for his wrong call about the market, right? And so, which is interesting by itself. But how important is fiscal policy when you look at things?
Well, I would just point out, guys, that it's your job as a economist or strategist on Wall Street to incorporate the fiscal outlook into your views. So using that as an excuse for why you may have missed the rally, I think you're sort of telling on yourself in a way. But yeah, I mean, I think it's to me, we haven't really seen this. I mean, remember, the 2010s were all about austerity, right? Austerity here at home, the budget sequestered, the defense, defense spending was weaker. We had that in Europe, right? I mean, with the European sovereign debt crisis and the austerity there. And we are entering, I think, a new era in the sense that, decarbonizing the economy, building up our semiconductor manufacturing capabilities. These are big projects. I mean, we obviously, and it's known now that we've depleted a lot of our munitions in the effort to defend Ukraine, and so that's going to require increased defense spending at some point. And there's more chatter in DC about that. Think of that as like another. I mean, and remember, national defense spending as a share of GDP has rarely been lower. On record than it is right now, and so it really only has one way to go, but up. So think of that as sort of another infrastructure program that's coming down the pike. To me, that's important. And if you're running persistent budget deficits, that money's going to have to go somewhere, right? I mean, it's kind of the sort of the public sector deficit, finds its way into the private sector, either through, stronger corporate profits, household incomes, some combination of those things.
That's definitely very much how we think about it as well. Go ahead, Brian.
Yeah. So Neil, I've got some either good news or bad news. We're halfway done. This isn't so bad, is it? I don't know if it's good or bad, but no. I mean, so let's take a little break here. I mean, we've got lots of listeners in Hawaii. Definitely everything going on in Maui. We're watching it, and our hearts break for everyone. So good luck to everyone there that's dealing with what's happening there. Neil, we talked last week. I think Sonu, you saw Bruce Springsteen, so I want to talk about that just for a second. But one of the playful things that we talked about on this very podcast, Neil, late last year was how hard it was to buy a Taylor Swift ticket. I said, there's no way we're going into a recession this summer with everyone buying these Taylor Swift tickets late last year, traveling to literally a weekly Super Bowl with Taylor Swift. You were just on vacation. Hopefully you're okay to talk about that. I mean, where were you, and was it crowded? And it just kind of say, just look around. This doesn't feel like a recession, right?
And if I remember, it was an anniversary, so happy anniversary.
Yeah, that's true. Yeah.
Oh, for me?
Yeah.
Yes.
Sorry.
Oh, yeah.
Sorry.
I I took my anniversary trip global, so I wasn't.
Yes.
I guess you can consider that. That would actually, I guess, count against U.S. GDP because it would mean that
import.
Oh, there we go.
It's a services import.
I'm still lifting activity globally. It's still fine. I mean, that's not exactly how it works. As we all know, you don't get rich by cutting imports. At any rate, I mean, the services side of the economy is on fire, and where I went, though, it was literally on fire. I was in Dubai with my wife. Over this, I think that was back in July, and man, I mean, it was like 115 degrees.
Wow.
Now, that's Sonu for a second thing, because I do want to dive into this. You were at Wrigley Field on, I think, Monday or Tuesday night last week. You're just getting your voice back, right, from screaming to the boss?
Yes.
How was that?
I mean,
how was that? Yeah.
That was pretty special. I mean, just so that if you haven't been to Chicago, so Wrigley is right smack dab. It's like unlike other stadiums, right? It's smack dab in the middle of a residential neighborhood. And I don't live very far away. I'm like about half mile up the road. And so you walk down the street to Wrigley, and halfway through, it's like one restaurant after the other, right? And everyone before the concert is just playing Bruce Springsteen music, right? Every single restaurant. So the whole atmosphere, the whole place is blaring. This is before the concert starts, right? You go in, as soon as he starts singing, everyone just takes up in unison, right? He probably didn't have to sing anything. The crowd had just sung for him, right? It was like being in church or something. I mean, so no, it was pretty amazing. And speaking of Jersey, Neil's in Jersey as well.
Yeah. I mean, the concert, I mean, I think, you talk about concerts. I mean, Metallica just sold out, I think, MetLife.
Yeah. Beyonce's been around too.
Beyonce, Taylor, yeah. I mean,
Barbie, Oppenheimer. It seems like it's a summer of all these, services of going out, concerts, movies, all of that.
So I don't want this to go. Sorry, I don't want this to go down to this. I saw Oppenheimer. I didn't really like it. Maybe I'm the only guy in the universe. Did you guys see Oppenheimer yet? I didn't. It was confusing. I mean, okay, we'll go off the rails. Neil, have you seen Oppenheimer yet by chance?
I haven't.
Oppenheimer. I haven't seen Barbie or Oppenheimer.
Okay.
I did see the Turtles Mutant Mayhem, though.
Yeah, there you go. Okay.
Yeah,
so
I don't know. Oppenheimer was great, but it was, I don't know. I like movies that are very easy to understand, like Fast and the Furious, right? I can understand those. So anyway, we'll get this back on track here. Fire away, Sonu. Let's try. We've got about 10 minutes. Let's try to get back on task. Although it is fun to talk about movies.
I do have a pet, topic which I definitely wanted to bring up. And speaking of manufacturing, but it gets to macro and how a lot of macro is done, analyze however you think about it on the street and, across, this industry. And people look at things like PMIs or, for that matter, they took a look at, what I'd like to call indicator macro. Take one indicator, plot it against, put a chart of it up against the S&P 500 and say, oh, the market's doomed, right? Whether it's M2 or the Fed's balance sheet, or the yield curve, it's inverted. We have to have a recession because it's inverted, without thinking through, okay, what's the story there? What's the mechanics behind it? And PMIs, I think, Neil, you already mentioned it, but I think that's kind of everyone's favorite, safe to say, in this business. Well, but I want to get your take on, how you think about that stuff versus what you do.
Sure. Well, I think in my framework of how I try to approach the job, I think the biggest mistake you can make in macro is just assuming that relationships in the economy are stable from one cycle to the next. That to me is a mistake, and it can lead you. It could put you in very hot water if you're not careful. And so I think, and the PMIs are a great example of that. I mean, first of all, the PMI is a good rough and ready indicator. I mean, but it's important not to get carried away with it. I mean, there's nothing the 300 purchasing managers know that are surveyed by it about the world that the rest of us don't, right? I mean, we're all looking at the same thing. And so that's kind of, and remember, the ISM, it dipped below 50 multiple times in the 90s, which was a period of relatively strong economic growth. I mean, so and you got false signals after the financial crisis as well. It's not so it's a good rough and ready indicator. But if you're going to ask me, like, what's a better indicator, 300 purchasing managers or when the BLS surveys hundreds of thousands of firms and they're adding to their manufacturing payrolls? Like, obviously, and there's not much of a time edge because the jobs data is released very early in the data cycle as well. This is a interesting year where the ISM has been sub 50, but we've generally seen manufacturing activity, manufacturing growth. So it's been sort of it's been offside somewhat. And as you mentioned, I mean, there are a lot of asset out. I mean, remember, you can explain like 70% of the ISM based on stock prices, corporate credit spreads, the dollar, and interest rates. You can basically run that in like a linear regression and basically get an ISM forecast.
And everyone does the opposite.
Use the ISM to run an asset allocation model when the assets are the things that are explaining the ISM in the first place. So that is my gripe with with a lot of that analysis. I mean, I think, as I say, it's like a good way to kind of frame a discussion, but to be running models off of it, Back when I was at Merrill Lynch, there was the thing called the ISM investment clock, and people have it's like a cottage industry on Wall Street. People have all sorts of little pointless rules that they come up with, like, oh, when it goes from 60 to 50, the Fed's about to cut. If it goes from 50 back up to 60, we're going to get a rally in commodity prices. And it's just like, yeah, maybe. I mean, but a lot of other things need to happen.
Well, that sounds more confusing than the movie Oppenheimer, I'll tell you. That's all I got to say. Anyway, so we've got about 5 minutes, so maybe one or two more questions. Neil, one thing I definitely want to focus on, inflation, right? We had the CPI number recently. The PPI came out, producer level, consumer level. I know you're in the camp that inflation's low now. Maybe that could be something that surprises, early next year. I mean, just take it away. What's your opinion of inflation right now?
My opinion is that inflation is likely to slow over the next couple of months because we do have this pipeline of disinflation coming from improving supply chains, and that's going to bleed into things like used cars, consumer goods like furniture, maybe apparel. We have some disinflation coming from shelter, right? Because rental inflation has generally been moderating, at least market-based rents. But the issue for me going forward is, do you think that the inflation weakness is a function of weaker demand or not? That's really the base, like the basic question you have to answer. And I don't think demand is really slowing.
Yeah.
So
Sure.
So if you have an above trend growth situation, to me, you're basically taking up physical resources out of the economy, and that will ultimately push prices up. I mean, the fact that home prices have already picked up, that's going to, with a lag, bleed into rents. I mean, if you're a landlord, what are you going to do? Charge people less because even if the underlying value of the asset that they're renting from you is going up, that's not going to happen. And look at the news, right? I mean, we had a huge sell-off in GM and Ford yesterday because investors are worried that they're going to pay up their workers a lot because of what the Teamsters were able to get out of UPS. So if you have this sort of wage inflation pushing up cyclical industries, is that not inflation? I mean, so to me, you're just increasing. You're pushing up household demand.
Yeah. Interesting. So is there, just to bring it to high level as we wrap, what's your story of the economy right now? I know you think, okay, it's likely to accelerate, but if you have to think, what's the story of the economy? I mean, what's driving economic growth right now? And are there any risks you see? I mean, which is not to say there are prominent risks or anything like that, but if there's anything that concerns you, what would that be?
Well, I think the economy can be described as resilient, right? I mean, that I think is probably the best definition, is that we have a resilient economy that has been able to absorb a significant rate tightening campaign. And frankly, the areas where you'd expect long and variable lags to show up are the ones that are accelerating. I mean, housing is okay, autos are okay. So the long and variable lag argument, in my mind, doesn't really work the way the bears are saying it. Remember, the way they're making the argument is that's an argument for the Fed to back off, to let it play out. But if the cyclical industries are the ones that are now already accelerating, it means, to my mind, that means they may have not done enough. So I think it's resilience. I think an important academic discussion is where are neutral interest rates? I mean, the Fed seems to think that things haven't really changed, relative to where we were before the pandemic. I don't know that I agree with that, given government spending, given the dis-saving that we're seeing. So in my mind, I think the risk is the Fed taking their feet off the brakes too soon. And if you buy into that, it means that the long end could come unglued later, right? Because the hawkishness has to seep in somewhere. And if the Fed's not doing it, then the market will do it for them. And that means that the back end might be mispriced. So I think that's really the risk. That the Fed is, prematurely declaring victory. And I think that opens the economy up for risk later.
Interesting. They take their foot off the pedal, so to speak, and then at the same time,
right?
Off the brake pedal, yes, yeah. Right, off the brake pedal, and then even as the economy is accelerating, and then they're like, oh no, we have to slam the brakes again.
Well, that's the thing, right? I mean, right now the Fed is. I've been saying they're sort of wish casting a soft landing, right? And remember, the Fed has been wrong at very important junctures. So they should be a little bit careful. You don't want to start patting yourself on the back too soon. And I think that's the risk that we're running. But we'll see. I mean, when you think about this job, it's what I know you put it in like sort of quadrants, right? I mean, you have the inflationary boom, you have stagflation, you have a deflationary bust, you have soft landing. What I know with the most confidence is that this year, the risk of recession has declined sharply. Okay. So now that means that odds of stagflation have gone down, odds of a deflationary bust have gone down for the simple fact that the economy is growing better than you thought. So now what the market seems to be going back and forth on is soft landing one week, inflationary boom the next, right? So the soft landing is great for stocks, right? Sure. Obviously. But if we're still in this sort of inflationary boom, that's a little bit more ambiguous for equities, but it's unambiguously bad for fixed income, right?
For bonds. Yep.
So that's sort of how I'm thinking about it. And I think maybe people put all their eggs in the soft landing bucket when you should be kind of saying maybe the risk of a soft landing has gone up, but there's also a higher risk of an inflationary boom too.
Interesting. It all should add up to 100% at the end of the day.
Right. It's about weighing probabilities.
Mm-hmm.
Well, that was awesome, Neil. Neil Dutta of Renaissance Macro Research joining Sonu and I on Effects versus Feelings, episode 47. Neil, final thing. Hopefully it's an easy one. This was awesome. Sonu and I are huge fans of you in the shop, all the cool stuff you do. Someone listening, where can they learn more about you, learn more about Renaissance, and how can they check you out?
Well, you can look at us on Twitter at RenMac LLC. And if you like what you're hearing, you can always look at us on renmacaccess.com.
Perfect. Yeah, then definitely check that out, everybody. It's great work, and hopefully you enjoyed the last 30 minutes. Well, Neil, thank you again for joining Sonu and I. We really appreciate it. This was a lot of fun. We learned a lot, and hopefully listeners learned a lot. So with all of that, episode 47 of Carson's Facts versus Feelings in the book. Sonu and I will be back next week for episode 48, and it should be fun. But thank you again, Neil. We'll see everyone soon. Take care.
Thanks,
Bye-bye.
Neil.
Thanks, guys. Appreciate it.